Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Nucor. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Now, on Tuesday's Stock Play of the Day, we looked for safety overall, and we looked for value in the underlying stock pick of the day. And as far as Tuesday is concerned, that feels like a month ago now, but it was actually only a few days ago. The stock that we looked at was Nucor, but I feel like I should mention the indexes just a little bit because we definitely had a volatile couple of days after Tuesday. And obviously the geopolitical news is really what's driving it. And I don't want to get into too much detail about it because everybody's talking about it. If you want some more detail on that, we're just here to review the paper trade that we did on Tuesday in Nucor Steel. So, as far as the SPX chart is concerned, I'm showing it right now. We see down, 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 1, 2, 3, 4 red bars after we broke below the 200-day moving average, and then 2 real strong green bars right after that. As a matter of fact, on the most volatile day when Russia did invade Ukraine, we had a swing in the NASDAQ to go from about down 3% to be at the end of the day about up 3%. So the VIX was a little crazy. And I mentioned this on Tuesday. We looked and we saw the VIX index. I'm showing my VIX watch list right now. We saw the VIX index trading just below 30. And I mentioned with the way the marketplace is, we got the Fed meeting next week, and a lot of focus is actually turned to what the Fed is going to do now, considering what's going on across the salt. We saw the VIX spike up towards the 40 level, and I mentioned that I thought the VIX was a little too low considering what was going on around the world. Not to mention just in our little part of the world in America with inflation, with interest rates. One of the only good news that we've had recently is the 10-year yield. It's actually below 2%, which I was a little nervous when we broke out above the 2% level and we stayed there for quite some time, that who knew where we were going to stop next. But at this point in time, we're still below that 2% level. That's just a nice round number. But if you look at the chart, which I showed on Tuesday's show, you'll see that there's a lot of support and a lot of resistance over the last few years right around that 2% level. So to have that down below, we have the Fed speaking next week. One of the things that they're kind of looking at is, I think a 50 basis point rate hike had potential. I don't think that it has potential now. I think we're leaning more towards the 0.25%, but it does look like a rate hike will happen. But the market has pretty much priced that in overall. So what happened in the marketplace this week, nobody could have foreseen. I did think that the VIX should have been higher, and the VIX did run up, and I'm going to highlight it one more time. Let's see exactly where it was here on this one bar in the VIX chart. The high was 37.79. So we didn't quite get to 38. The real high volatility now, I think, is defined after the pandemic. I would define it above 40%. That's when we're in extreme volatility levels. Extreme is a strong word, but high volatility where marketplace is very nervous about what's going on. I was really surprised at the beginning of the week to see the VIX up towards down the 30 level. And after that wild swing in the marketplace, now we actually see it lower. Down around the 27% level. Who knows what happened? I mean, one of the big things that a few people are talking about is the fact that They started protesting in Russia. And obviously, you're taking your life into your own hands if you're protesting in Russia, protesting the war / invasion, whatever you want to call it, that's happening in Ukraine. So let's get into the reason why we're here to review the stock play of the day paper trade that we talked about on Tuesday. It was in Nucor Steel. So what happened with Nucor Steel? Oops, that's the actual chain. So with Nucor Steel, I'm going to start by looking at a 1-year chart that I've zoomed in on. Highlight some of the moving averages. We have a 200-day moving average. We have the 20-day in green and the 50-day in red. And we went down with the 20-day below the 200-day, which is actually not a good thing as far as moving averages are concerned. They would call that a death cross, but it didn't stay there very long and made an upturn. And all of a sudden now it's a golden cross. So not much happened as far as that momentum swing and everything. But right here, we had a solid move from the 20-day going back above the 50-day. That means we've got our ducks in a row now. We have the 200-day, the 50-day, and the 20-day all in a line. This is the way we like to see it. And considering what's going on with the rest of the world, actually on the down day, Nucor Steel didn't have a bad day at all. And I'm going to put my cursor in the middle of the chart and highlight that if you look over, as of right now, we're on the precipice of a new high. We're just kind of hanging out right there, right at the 128.70 mark. And in general, this market did fairly well. So now I'm on a 15-minute chart. On Tuesday, which the markets were closed on Monday. This is about 12:15 on Tuesday when we're looking at the trade. Market did come down while we were talking about it, and then it actually had a down move going into the end of the day. So this is when we were looking at Nucor Steel, and that was 122.50. Now, down day, next day, down day, and then strong move to the upside all the way to where we're at right here at 127.83. So what strategy did we look at? We talked about getting your feet wet, a rookie's play. I've recently, since the pandemic, called these FOMO trades, fear of missing out. How can I use options to reduce my overall risk compared to buying 100 shares of stock and get something that acts like the stock as a surrogate for the stock? And that's highlighted inside the optionsplaybook.com, my book, in the rookies corner. And I call it getting your feet wet, buying leaps calls as a stock substitute, and kind of outlines the entire plan. On the call, we had a question from someone about a fig leaf or selling some short-term premium against it. To be blunt, very rarely, even on a stock, do I buy the stock and sell the call right away. That's just not really my forecast, unless that's totally your plan, that you're looking to bring in premium above and beyond dividends. Most people, if you're trading a portfolio and you're watching it or swing trading it a little bit more than just the good old buy and hold, you would usually wait till the stock went up. Why? Because you bought the stock because you thought it would go up. That's why you bought the stock. And then target a sell price by selling a call against it. And definitely in the leaps world, that's kind of going to be my approach with it. I want to see if the market is going up, and then I'm going to sell a call against the position, if that's what I wanted to do and how I wanted to try to reduce some of the time premium that I have to pay by going out longer term. And that's all that LEAP stands for, by the way. I keep saying it, and I always feel like I need to define it. It's just long-term equity anticipation securities, which is just a marketing term that the Chicago Board Option Exchange came up with that said the LEAPs are usually considered to be longer than 9 months out in time. We didn't go that far out. We went out until July, to the July expiration, and bought a deeper in the money option contract. So today, I'm going to give you an alternative. I always like to try, if the stock is down, I'm going to give you a way to adjust it. That's the norm. If we are up, I'll say at this point in time, I would consider looking at a fig leaf, turning this into a leveraged covered call, which is another name for it. But I'm going to highlight that section in the playbook one more time here. Here's the fig leaf. If you want to read about it, it just means that we have something that looks like the stock. It's a surrogate for the stock. we're going to sell a short-term call then against that surrogate for the stock. But there are nuances. We have something that acts a lot like the stock by going deep in the money, more expensive option contract, but we don't own the stock. And hence the name that I came up with in the playbook is the fig leaf, because we're kind of covered. We are covered as far as the brokerage firm is concerned, but if we were to get assigned, we'd have to do something with our position. It's not a simple no-brainer like a covered call is, in that they call my shares away. If I want them sold at that strike, well, then call them away. And I'm going to sell at that strike price of that call option that I sold. So that is, so the fig leaf takes a little bit more maintenance overall. So because of that, we usually sacrifice by going up in strike to try to reduce the possibility of being assigned and give up a little bit more of the premium. Why? Well, we didn't pay as much for the control of the stock, right? We're renting the stock as opposed to buying it in general. So because of that, when I look at this strategy, I'm willing to give up premium because I really don't want to be assigned on it. Okay, so let's look at how that works. I'm going to go back to the option chains. I think they're right here. Yep. All right. And I usually start by looking at where the stock is at, just so we get our, oh, wow, we're up 7 right now. So we're up 6% at 128.25. So looking real good. I think we're up a little bit more than even when I first started looking at this option chain. Now, there's no earnings date, and that's fairly important to me because I do not want to be selling a call on a long option position around an earnings date, because I don't want that surprise to drive the price to a point where I can't roll it, I can't close it out, I can't adjust the trade, and I get assigned on it. It forces my hand, is what it would be. I'm looking for normal times. I want to bring in some decent premium and help whittle away at the time premium that I had to pay for my long option contract. So this is the expiration that we're going to look to sell in. It's 14 days away. March 11th. The one that the paper trade, the official paper trade from Tuesday, was the July 15th option expiration, 140 days away. The 105 strike call. So we were targeting something around an 80 delta. It was a little bit less than that. It's now in the money. Right now, the midpoint is 28.15. So when we did the trade on Tuesday, the midpoint was around 24.30, and you can never guarantee a midpoint fill, especially when you're dealing with deeper in the money option contracts. But it usually we try to compare apples to apples. So the midpoint was 24.30 when we're looking to buy it, and that's about 20% of the stock price. So we're limiting our risk to that. And we talked about how we would adjust the trade if the market came down, went against us. And right now we could sell that for 28.15. So we've gone up about just under $4 over the last couple of days. So at this point, now that I got a little bit of a gain in it, I don't mind selling a call against the position. So which one would I sell? So if we look at the strike prices that are available, there's still a lot of premium. We're trading at about a 46% implied volatility. That's, to me, some volatility and some predictability. I don't mind that range. Might like it down a little less, actually, just so that I get a little bit more of the predictability side of things. But if I go all the way up to the 138 strike, 10 points higher, I'm getting 120 by 152, a little bit wider market. Has to do a little bit with the volatility of the marketplace. So overall, and if I was selling this against a stock and I actually owned 100 shares, I would consider the 138 strike. Now I meant to go a little bit higher. I'm going to look to try to bring in somewhere around 90 cents on this option contract. So we're going to go up to about the 142, I think 140. Okay, so the 140 is 65 by 120. 145 is 36 by 68. Okay, so we're gonna target the 140 because we don't have a 142. Looks like we go to 5-point strikes when we get to that level. And I want to try to sell it for $1 or 90 cents, somewhere around that. We have a little bit of a wide market, so we're going to have to work the order in order to get this trade executed. So this would be the adjustment trade. I have the long option contract in, and this is what the fig leaf would look like. If I go to the options workbench, see the midpoint's right around 93 cents here. If I am already long the option contract, and then I sell the shorter term option to get it against it, we're going all the way up to the 140 strike. So we're going 12 points higher than where the current marketplace is at, 128.13, trying to bring in about 90 cents. And that 90 cents is helping us whittle away a little bit at the time premium that we had to pay when we initially bought this deep in the money option contract as a surrogate for the stock. All right. That's it for this episode of Stock Play of the Day Overtime. Click subscribe, ring the bell, and we'll see you this coming up Tuesday for the next Stock Play of the Day. Thanks for coming, everyone.